There is a building near you right now that costs somewhere between $1.5 and $5 million to construct. It runs almost around the clock. It employs maybe 3 people per shift. It has no inventory to manage, no perishable goods, and its product costs about $1.50 to deliver. And quietly, in the right location, it generates over $1 million in revenue every single year. You have driven past it hundreds of times. You have probably used it. And until very recently, nobody in the financial world gave it a second look. That building is a car wash. And in the last decade, it went from one of the most overlooked businesses in America to one of the most aggressively acquired assets in the country. Private equity firms poured over $10 billion into car washes between 2019 and 2022 alone. KKR, one of the most powerful investment firms on the planet, spent $850 million buying a stake in a single car wash chain in 2024. The largest car wash company in America went public on the New York Stock Exchange in 2021, with shares trading 49% above their IPO price on day one. By 2026, it was taken private again in a $3.1 billion deal. Institutional investors did not lose faith. They decided the model worked better away from the scrutiny of public markets. Something changed, and it wasn't the soap. Let's start with what a car wash actually costs to run, because the numbers are stranger than most people expect. The variable cost to wash one car at a modern express tunnel is approximately $1.50. Water, electricity, chemicals. That is all. On a basic $10 wash, your gross margin is 85%. On a premium $25 package, it is 94%. These are software company margins on a building made of steel and fiberglass that pushes cars through soapy water. But those margins alone do not explain the billions flowing into this industry. To understand that, you need to know how the car wash got here. For most of its history, the car wash ran on one of 2 models: the full-service wash, teams of workers scrubbing, vacuuming, and toweling down every vehicle by hand. High labor costs, slow throughput, maybe 40 cars an hour on a good day. Or the self-serve bay, coin-operated, customer does all the work, revenue ceiling somewhere between $40,000 and $100,000 a year. Neither model attracted serious capital. Then came the express exterior tunnel. A car rolls onto a conveyor belt. A machine washes it. 3 to 4 minutes later, it comes out the other side clean and dry. No human hands touching the vehicle, just the exterior. Done fast, done consistently, done at a rate of 60 to 100 cars every single hour. The math on this model is worth slowing down for. A well-located express tunnel running 12 hours a day can move somewhere between 5,000 and 8,000 cars per week. At an average ticket of $15, that is $75,000 to $120,000 in weekly revenue, per location, from one building. But volume alone is not what attracted $10 billion in private equity capital. Volume was just the foundation. The real unlock came from a model that had nothing to do with washing cars. It came from a subscription. Here is what the car wash industry figured out. Customers who pay a fixed monthly fee, say $30 for unlimited washes, behave completely differently from customers who pay per visit. They come more often. They stop thinking about the price before each wash. The friction disappears. And from the operator's side, the economics are extraordinary. The average member washes their car 2.6 times per month. At a marginal cost of $1.50 per wash, the total cost to service that membership is about $4 a month. At $30 a month, the spread is $26 per member. See now, before fixed costs. The member who loves their car and washes it 10 times in a month costs you $15 to service. You still collected $30. The math does not break, even for the most enthusiastic customers. But the real power of the membership model is not in any single customer's economics. It is in predictability. Picture what this actually looks like from the customer's side. You pull up to a car wash. A camera above the entrance reads, "Your license plate." A gate swings open. You drive in, sit in your car, radio on, and the machine does everything. 3 minutes later, you pull out clean and dry. Your app charged you nothing today, because it already charged you on the first of the month, quietly, automatically, while you were doing something else entirely. You did not think about the price. You barely thought about the car wash. You just drove in. Think about what a car wash looks like without memberships. Revenue depends entirely on how many people decide to wash their car today. It rains for 2 weeks. Revenue drops. Gas prices spike. People drive less. Revenue drops. The business rises and falls with weather and impulse. Now add memberships. A floor appears. $30 per member every month, automatically billed, regardless of weather, regardless of gas prices, regardless of whether the economy is expanding or contracting. Members kept paying through COVID lockdowns. They kept paying through inflation. A monthly car wash subscription costs roughly the same as one dinner out. It is not the first thing anyone cancels. You are not selling clean cars. You are selling access. And that changes everything about what kind of business this actually is. Mr. Car Wash is the clearest proof of what this model can become. The largest car wash chain in the United States, 549 locations across 21 states, and 2.5 million active members. In its most recent reporting, 76% of its total wash revenue came from its Unlimited Wash Club membership program. 76%. More than 3/4 of its revenue arriving automatically every month before a single car pulls into a single driveway. And then in 2026, Leonard Green and Partners took it private in a $3.1 billion deal. That is not a retreat. That is institutional capital deciding that a business generating this kind of predictable, recurring cash flow is worth more out of the public eye, where it does not have to explain its model to analysts every quarter and can simply keep compounding. Top-performing individual locations with strong membership penetration can reach adjusted cash flow margins between 45 and 67%, according to industry analysts. A single well-run express tunnel in a good location can generate $1 to $2 million in annual revenue. Build a cluster of locations across a metro area, cross-link the memberships so members can use any location, and you have built something that looks far more like Spotify than a place where you clean your car. This is what private equity recognized. And from 2019 to 2022, they moved fast. They bought mom-and-pop operators who had run the same single-location cash business for 20 years, rebranded them, installed modern membership programs, added license plate recognition technology so members could drive through without stopping to scan anything, made the experience frictionless at every possible point, then bought the next one, and the next one. The industry is extraordinarily fragmented. There are nearly 60,000 car wash businesses in the United States. Even the largest operator controls less than 1% of the total market. For private equity, that is an open invitation. A highly fragmented industry, proven unit economics, and a recurring revenue model that only improves at scale. Some of the same investment firms that back major software platforms and global logistics networks were now in the business of selling $10 car washes in suburban America. One of those firms put $850 million into a fast-growing regional chain in 2024. Not a bet on soap and water, but a bet on subscriptions, fragmentation, and the belief that a scaled express car wash trades more like a consumer software company than a traditional service business. In M&A, locations with strong membership programs were being valued at 5 to 7 times EBITDA, multiples that would not look out of place in enterprise software. But here is where the story gets more complicated. One major roll-up platform followed the exact same playbook. Acquire fast, add memberships, repeat. By 2024, it had grown to 260 locations and $345 million in revenue. The model was working. The problem was what it borrowed to build it. Over $650 million in floating rate debt. When the Federal Reserve raised interest rates aggressively through 2022 and 2023, the platform's annual interest expense jumped from $59 million to $93 million in a single year. The cash flow that made the business attractive was being routed directly to lenders, not to growth, not to new locations, to interest payments. In early 2025, that platform filed for Chapter 11 bankruptcy protection with roughly $654 million in debt and less than $1 million in cash. 6 sites in Florida sold during the restructuring for a combined $58 million, nearly $10 million per location, proving the real estate still had value. But the locations could not outrun what surrounded them. The debt load, the labor cost pressures, and the roughly 900 new car wash sites entering the market every year had made the competitive environment far harder than the roll-up spreadsheet had assumed. The subscription model still worked. The capital structure and the competitive timing did not. The lesson is not that car washes are a bad investment. The lesson is the same one that appears at the end of almost every private equity boom. The underlying business can be genuinely excellent, while the financial engineering layered on top of it is reckless. Car washes work. Car washes with $650 million in floating rate debt during a rate hiking cycle are a different problem entirely. The industry absorbed that bankruptcy and kept moving. More than 2 million vehicles are washed at professional facilities in the United States every single day. The U.S. market reached approximately $18.5 billion in 2026. 79% of Americans now prefer professional car washes over washing at home. In 1996, that number was closer to 40%. And the express tunnel model, which barely existed 15 years ago, now controls more than 50% of the North American car wash market. Full-service washes, the ones with teams of workers, have collapsed from 80% of the market to roughly 15%. Automation and recurring revenue beat labor-intensive models. They almost always do. But there is another sign the gold rush may be maturing. In some American cities, residents are no longer asking why car washes are everywhere. They are asking whether there are too many. In March 2026, one Texas city passed a 180-day moratorium on new car wash construction. A city in Oregon began reviewing zoning changes to limit where new facilities could be built. These are early signals, not a trend. But they are the kind of friction that tends to appear when a niche investment strategy scales far enough to become visible to the people who actually live next to it. When local governments start talking about traffic, water use, and saturation, it usually means the easy phase is over. The car wash is a case study in something that repeats itself across ordinary businesses more often than people realize. The product, a clean car, did not change. The machines got better, but the fundamental service has existed since the 1940s. What changed was the business model sitting on top of it. Somebody looked at a transactional service that people used regularly, something habitual, low cost, and recurring, and asked a simple question: what if we charged per month instead of per visit? That question turned a car wash into a subscription platform. It turned a local service business into a private equity target. It attracted billions in capital to an industry that most people still drive past without a second thought. And it raises a question worth sitting with. What other ordinary services are running on a transactional model right now, serving customers on a regular, recurring basis, that nobody has thought to flip into a subscription yet? The car wash took 80 years to figure it out. Something else is probably next. If you want to find out what that is before everyone else does, subscribe to The Economics Machine. Every week, we take something ordinary and show you what is actually going on underneath it.